in different ways. We have a great panel of experts reflecting today's theme. They range from up and coming to seasoned veterans who are going to walk us through that progression in chronological order. And for those of you who haven't noticed, this is also sort of an Academy showcase with 3 of our staff speaking on this panel. So in addition to myself, you'll be hearing from Jay Patel, who is our research assistant for income security. He comes to us from CBPP and has been focused since he's come on workers' compensation. And you'll also be hearing from Bethany Cole, our research assistant for health policy, who has led the Academy's work on Medicare, Medicaid, and more recently, caregiving. Jay and Bethany are joined by Steve Goss, Chief Actuary at the Social Security Administration, who, although he needs no introduction, is a member of the Academy, a very longtime friend, and a former Ball Award winner. We're also joined by Michele Evermore, a senior policy analyst at the National Employment Law Project, who's going to talk about UI, a program that, as you all know, has been getting exponentially more attention over the past few months for very good reason. And finally, we will learn about Medicaid's important contributions from Rachel Nuzum, who is the Vice President of Federal and State Health Policy at the Commonwealth Fund. Again, so going in chronological order, I'm going to turn it over to Jay to talk about workers' comp.
Great, thanks, Elaine. As Elaine said, we'll be starting off with workers' comp, which surprises many people, learning that it's the oldest social insurance program in the United States. And like many other social insurance programs, it was a reaction to the time period it was in and the conditions of that time. So to really understand it, we have to go back to the turn of the 20th century, where heavy industrialization was occurring in the U.S., but had a major cost in that workers were being maimed and dying en masse due to the unregulated and dangerous work conditions. These included things like railroads, construction sites, factories, and sweatshops, where workers were filtered into unventilated and unregulated working conditions filled with dangerous machinery and toxic chemicals. When workers were injured, there was very little recourse for them to take. They either had to take their employers to court and hope to win, or rely on charities and community programs for assistance. When they took their employers to court, the employers relied on what is known now as the unholy trinity of defenses, which included contributory negligence, which meant that if the employee was found in any way to have contributed to their own injury in any manner, the case was not valid. The fellow servant rule, which meant that if another employee was found to have contributed in any manner to the injury, the case was not valid. And something that was the assumption of risk, which was later known as death contracts, which saw many factories and employers have their employees sign a contract that said that they knew and assumed the risks of a job, and that subsequently lost them any right to challenge it in court. Even in successful claims, the benefits were far too little and took far too long for the families to receive, often driving them into poverty. So this trend continued, which led to a public outcry, combined with the great advocacy of the progressive era and increasing litigation, saw the first workers' comp laws passed in the 1910s. Throughout the next 10 to 15 years, we would say, almost all of the states, bar one or two, there was, I believe, Mississippi that didn't come until 1943, had in one form or another, some kind of workers' compensation policy in place. And if it was any other time, we'd be celebrating the 100-year anniversary of workers' comp. But of course, there's so much going on that we've decided to push back some of the celebration of workers' comp into next year, looking back and examining what's been going on and the development of workers' comp in the past 100 years. So look forward to that. So just like other social insurance programs, workers' comp has evolved and changed to sort of fit the times and modernize, but the basics of the program remain the same. It's a no-fault insurance scheme that provides cash benefits and medical assistance for workers for covered illnesses, injuries, and death with no regards to fault. And in exchange, workers give up their right to sue their employers, except in the most extreme and narrow circumstances where they still retain that right. And because these laws were enacted, like I said, about 100 years ago, it is the only social insurance program not to be have any federal funding or have any federal oversight, and is fully managed at the state level, which there are some exceptions to it. Certain diseases like there's like a black lung fund, and federal employees have their own workers' comp programs. Aside from that, it is fully at the state level, which has, as you can see from our annual report, huge disparities in benefits depending on which side of the border you live on and in which states. But workers' comp has a huge impact for workers of all ages, across all occupations, and across their entire careers. Dangerous positions still make up for many of the claims and definitely make up a higher percentage of severe claims. But most modern cases are due to repetitive stress injuries, car and truck accidents, or in my case, a rogue table that fell off a dolly and broke a couple toes. So it has huge implications for providing safety and ensuring coverage for workers in all occupations, of course, depending on the state. And just like Social Security, it provides survivor benefits for families of those who've lost loved ones. But even in case of just injured workers, it provides a portion of lost wages, as well as medical care, which can be quite extensive. It can provide lifelong benefits even. And just like other social insurance programs, we are seeing gaps and cracks in the system. Some of them have been there since the very beginning that were never addressed, and some of them are emerging issues like the exclusion of non-standard workers and contract gig workers in workers' comp. And as you'll hear from other social insurance programs and some speakers after me, these disparities tend to amplify and exacerbate existing systemic racial injustices. And that's something that we here at the Academy are really working towards and examining some of the data. And I'm excited for next year to go ahead and dig into some of these issues and find ways to reform workers' comp and modernize it and address all of these issues that still continue to plague it.
Well, wonderful to be here today. And I know which end of the intergenerational spectrum I am representing with all of the young people on this panel and in general here today. Thanks to Bill, Christine, and everybody else for the invite, and Elaine for having me on this panel. So Social Security, I've been working in this program for a little while, and I guess one little joke is when I retire, I will be one of the last people probably to have been working at Social Security for more than half of its lifetime. But we'll see how that works out. So Social Security was enacted, as I'm sure everybody knows, initially back in 1935 in response to the Great Depression. At which time retirement savings in general, and prospects for retirement had been devastated. So Social Security really sort of came to the rescue. It was something that the nation needed, the nation wanted, and it came to pass. Initially, payroll tax contributions started in 1937 at only 1% of pay each for employers and employees. And this was by intention. And by the way, the intent of the Social Security program is it doesn't do everything for everybody. It probably cannot, and it could be expanded, but it's really intended to be based on an earned right for workers who have worked in the above ground economy and who have paid the payroll taxes in along with their employers. And of course, self-employed workers were brought in later. Now, the first monthly retirement and survivor benefits were paid out of Social Security 5 years after enactment, and 3 years, in fact, after payroll taxes started. That was in 1940. And the requirement in order to receive a retirement benefit at age 65, as of 1940, was that you had to have worked for 2 of the prior 3 years, 1937, 8, and 9. So there was an earned right aspect of this from the very beginning. One comment really to sort of keep in mind with Social Security, and I think EJ had alluded to this, about the ability to provide benefits of any type and to do anything in our society, is the fact that we have a dynamic and a growing economy. You know, the question is, how do we tap into that to do all the things we want to do? But one thing to keep in mind with Social Security is that it has been operating essentially as a pay-as-you-go system, like Medicare, like most of our programs. And we could have a long discussion about the meaning of that. But what that basically means is the workers of the day are paying in money. And to the greatest extent, that is what's paying for the benefits of the day. That's in effect really sort of like the ultimate of intergenerational program. So Social Security is operating at any given point in time where the money coming in is from the workers of the day of that generation, people, you know, 20 to 65 or so, and it's funding benefits for people who are very young, very old. It's really a cradle to grave situation. But the reason I mention the importance of the pay-as-you-go is because imagine back in the very beginning, if Social Security had been financed on what is sometimes referred to as a fully advanced funded basis. That would mean that we would have had to start to have young workers pay in for their whole careers, and only after they reached retirement age would we ever pay out any benefits. We'd have a fully advanced funded system. Well, the system could not have accomplished what was intended at the time of the Depression to be able to provide benefits for elders at the time. And in addition, there's another effect that we don't oftentimes think about. If Social Security was holding the tens and tens of trillions of dollars of reserves, which would be required for it to have as a fully advanced funded system, that would be money which has instead been left in the hands of private individuals to invest individually. And any economist will tell you that probably we are arguably better served by having the private economy create all the investments of all types in our economy, and for individuals to be making market decisions, and we have a more efficient economy as a result. So pay-as-you-go financing has really, really been important. In addition to the retirees and survivors and spouses and children of retirees that we had initially, by the time we got to 1957, the program was expanded, and we also included disabled workers. EJ mentioned earlier sort of what share of all of the beneficiaries and benefits go to different types. Well, it's about 70% for retirees and their auxiliary beneficiaries, spouses and kids, and about 15% each to disabled workers and their families and to survivors. So it really sort of covers the spectrum. It really is a cradle to grave concept here that covers benefits for people who are in need of them, who are beyond the age of working or who are unable to work. But again, it is based on an earned right program based on earnings that people have paid in. Now, the benefits provided under Social Security are really intended to be a foundation for income security. Social Security does cover about 95% of all workers. The real exceptions are some state and local government employees who are in a program and therefore are not covered under Social Security. But almost all workers in the above ground economy are covered under Social Security. And it is intended, however, to really provide what we sometimes refer to as a floor of protection. It's not intended to provide everything and all that would be desired or needed in retirement. Most of the time we hear, financial planners say you might want to have 70, 75, 80% of your income while you were working available when you go to retire or at other times when you're in need. Social Security is not intended to do that necessarily, although it does for about the lowest 10% of our career earners provide a replacement rate that is a benefit relative to the career average earnings they had that is about 90%. That's by design of the current benefit formula. Now, for an average worker, that replacement rate, the benefit level in retirement or in disability relative to your career average earnings is more like about 40%. And for the highest earners, and we should mention the highest earners are the ones who have been advantaged generally and will expect to live longer and receive benefits longer, they receive a benefit replacement rate closer to 25% relative to the career average earnings they had that they paid taxes on. So there really is a real progressivity to the system. It's true that the payroll tax rate up to our taxable maximum amount is a flat payroll tax, but the benefit structure itself is really quite progressive. So the combination of that is really something to pay attention and makes a difference. So Social Security, speaking to the intergenerational concept, it's not intended and never has been to be static, a static, fixed form. It's really been intended, and whether or not intended, it has evolved to the needs and desires of each new generation. That's to be expected in the future. We will see how it evolves in the future. And as EJ said earlier, I'm hoping also to be around long enough to see what the next upcoming generations are going to do to sort of modify this program over time. However, there is a challenge facing us ahead for the financing of Social Security, a financing which is inevitable for a program like this that is paid for on a pay-as-you-go basis. And the challenge is the changing age distribution of our population due to lower birth rates that started after the end of the baby boom period. So just in a nutshell, what that really means is that we are really going to have fewer workers per beneficiary in the future. And that is the main thing that we're going to have to adapt to and that we're going to have to change. So I think my time is up and I should be moving on and passing the baton to Michele. So thank you again very much for the opportunity.
Thank you. I'm really excited to be here. This is a great opportunity to talk to you. Thank you for inviting me. So unemployment insurance. This is a fun time to be an unemployment insurance analyst. There's so much going on, but I want to start out by talking about just, this generational question. So obviously unemployment insurance by definition only applies to you during your working years. But I would point out that the likelihood of applying for unemployment insurance benefits does increase with age. According to non-filer data produced last year, about 7% of unemployed people between ages 16 to 24 even applied, compared to 32% of those age 25 to 54 and 37% of those 55 and over. So this is definitely a program that once a person becomes familiar with unemployment insurance, they're a lot more likely to apply again in future periods of unemployment. So hopefully we've seen during this pandemic, a lot more people are eligible for unemployment insurance because there's a new pandemic unemployment assistance benefit parallel to regular unemployment insurance. So hopefully this gets people in the habit of applying and of using this really important program. So going back in history, this was part of the Social Security Act, unemployment insurance, and it comes on the heels, of course, of the Great Depression. And so paying people who have involuntarily lost work seemed like a really good idea, particularly when you look at 1934. There were massive strikes in Minneapolis, the San Francisco Bay Area, the longshore workers struck and brought with it a citywide general strike. Textile mill workers were striking up and down the East Coast. There was massive unrest among unemployed workers. And there was also this Townsend movement, which was basically a UBI proposal at the time of $200 per month, financed by 6% payroll. So as UI was part of the Social Security Act, the political and social moment that brought Social Security also brought unemployment insurance. So what does this program do? Essentially, there's a federal unemployment tax of 6% on every employer in the United States. If the state that they live in sets up a system that conforms to some really basic federal guidelines, then those taxes are reduced to 0.6%. So that was the incentive to set up an unemployment insurance program in the state. And so by 1937, every state had one set up. What are the basic goals of unemployment insurance? So it's obviously income replacement when work is involuntarily lost. It promotes an attachment to work by having workers file through the employment services system, and gives people reemployment assistance. And this is important because as recipiency, as access to unemployment drops, so does access to those kinds of services, and that's really important. It, as we might have noticed lately, provides a counter-recessionary macroeconomic stabilizer effect during recessions. And this is a really interesting factor right now, is that unemployment insurance was designed to resist downward pressure on wages, or provide what's called a reservation wage, so that people who find themselves unemployed, actually they have the space, they have the security to find a job that suits them. again, it also provides, access to job search and training assistance as people are out of work. So when do workers qualify? They lose a job or their hours are dramatically decreased. They can, and so involuntarily is an interesting concept. So a person can be laid off or they can quit for a couple sets of reasons. There are good cause quits related to personal reasons, such as relocating with a spouse or escaping domestic violence, or being asked to do something illegal, or for health and safety reasons, which is particularly important right now. That question is really coming up quite a bit as people are being asked to work in unsafe environments due to COVID-19. Employers can and do challenge the reasons for workers quitting, because it is a requirement of federal law that they are taxed based on their experience. So they're taxed based on how much their workers access the system. So the routinization of challenging benefits is really a problem. And then workers have to meet continuing eligibility guidelines every week, meaning they're able, available, and actively seeking work. So who gets it? I think because the program was established in 1935 and not dramatically modified since then, access is optimized for people in long tenured stable jobs. As we've seen in this recession, nearly half of workers getting a benefit are getting it through the new PUA program. And states have been doing things like increasing monetary eligibility requirements that leave lower income workers out of the program. And also new work structures are dramatically affecting access as the economy turns more into a gig economy. And because like workers' comp is a federal state system, states have broad discretion to set eligibility requirements, weekly benefit amounts, duration, disqualifications, and payroll tax mechanisms within the basic federal guidelines. So the systems vary quite a bit across states. And that leads me to just the last point that I want to make about some real flaws in the system. I love unemployment insurance, but you can't love something without wanting to fix it. Because there's such uneven access across states, one thing that you'll find, and that's really important to keep in mind in this moment, is that the states with the stingiest benefits also tend to be the states where the most Black workers, Latinx workers, and Indigenous workers live. And so there's unequal access to the program in a very racially charged way. And that's why, we have been arguing that we need either a better federal floor or to really consider federalizing this program. Otherwise, states end up, sort of locked in a race to the bottom to have the lowest taxes and the least coverage. And so I hope that, we can come together and work on this going forward.
Hi, everyone. I'm going to just quickly talk about Medicare for a few minutes. So I'm going to start by talking about the state of health insurance before Medicare was enacted. So prior to the enactment of Medicare in 1965, the elderly over the age of 65 were the most likely to be in poverty, and nearly 1 in 3 were living in poverty. They were also the most likely to lack health insurance coverage, with nearly half going without health insurance coverage compared to just 25% of the other parts of the adult population. In addition, retirees also faced medical bills that are roughly triple those for everybody else, with more than 1 in 4 seniors going without care during that time due to costs. And so when Medicare was enacted, it was really designed to try to provide a system for insurance for those retiring and no longer having access to their employer-sponsored insurance through their work environments. Originally, it was just a Medicare Part A hospital insurance trust fund and a Part B program to cover physician services, and just for those over the age of 65. So over the next 55 years, Medicare has undergone significant transformations, including a large eligibility expansion in 1975 to include eligibility for those with long-term disabilities who are receiving benefits from the SSDI program, as well as a couple of health condition-based expansions for those with ESRD, end-stage renal disease, and ALS, also known as Lou Gehrig's disease. Medicare is also involved in two additional parts, including Medicare Part C, Medicare Advantage, and the Part D prescription drug benefit. And something about Medicare that I think is really interesting and pertinent to discussions about intergenerational benefits is that it is a pay-as-you-go system similar to Social Security, in that the Part A trust fund is financed by current payroll taxes mostly for retirees of a different generation. But it's not quite as simple as that with Medicare, because that's only for one part. So parts B, C, and D of the Medicare program are mostly financed through general revenues and premiums. And so it's not as clear cut of an intergenerational transfer as other social insurance programs are, because a good chunk of it is financed through general revenues. And additionally, benefits are not proportional to income in the same way Social Security is. So someone who paid more into the system is not necessarily going to receive more Medicare benefits than somebody else. It's just based off of work history, and just the amount of work history, not income levels at all. So some of the intergenerational impacts of Medicare. So Medicare currently provides coverage for approximately 62 million people. 52 million of those are people over the age of 65, and about 9 million are people under the age of 65 with a long-term disability. So before Medicare was enacted, healthcare spending was incredibly costly for seniors and people with disabilities, and that used to drive people into poverty or really, really burden families and having to pay for medical care. We still see some of that today with long-term care, which I'll discuss a tiny bit later and in the next panel. So while 48% of the elderly lacked coverage in 1962, that's down to about 2% today. So almost 98% of seniors now have coverage, which is a huge accomplishment of the Medicare program. Additionally, it has been cited as a major reason that we've seen such a big reduction in poverty among people over the age of 65. So this is down to about 9.2% of people over the age of 65 in 2007, compared to almost 30% prior to Medicare's enactment. And as I've stated, there are approximately 9 million people under the age of 65 who are currently enrolled in Medicare, which I think is a big misconception among younger generations, of not seeing that this isn't just a program for people over the age of 65. It also protects everyone from the risk of incurring an injury or something that leaves someone with a long-term disability. So you have a source of health coverage for that. And I think that especially younger generations kind of have a invincibility mindset of not seeing how they could develop a long-term disability before the age of 65. I think a lot of people think, oh, that's not going to happen to me, but it can. And it's important to remember. Additionally, we've seen, same with Social Security, is the kind of intergenerational the relief of an economic burden. So it's no longer that people over the age of 65 or with a long-term disability and their families are responsible for the entirety of their medical costs as they used to be. So that's a huge economic relief for younger generations. Like, for example, my grandfather is currently undergoing chemotherapy, and obviously he's on Medicare. So my family, my parents, my uncles, my aunts aren't, sacrificing our current income to pay for his chemotherapy costs. Like we would have had to, if chemotherapy existed before Medicare, having to go into our own pockets to cover that, or be forced to make a choice of foregoing his care. And so I think it's really important to remember those intergenerational benefits of making sure that seniors have healthcare coverage and aren't living in as high of poverty rates. Even though it's important to remember also that there are still significant affordability issues, there are still seniors and people with disabilities who forego care because of costs, and those problems aren't completely addressed by the Medicare program, particularly when it comes to financing and paying for long-term care. So with that, I will turn it back over.
Thank you so much. Thanks everyone for letting Medicaid join the social insurance party. Medicaid is the little sister of Medicare, if you want to think of it that way. They were passed at the same time in 1965, passed by Lyndon B. Johnson, notably 20 years after they were proposed by Truman, which, just for folks who are grappling with trying to make policy changes, a good reminder that health policy does not move quickly. It takes a lot of time, unfortunately, and I have to keep reminding myself about this arc of history, and it's a long one. So Medicaid, like I mentioned, was passed at the same time in 1965 as an extension of the welfare program, and the the belief all along was that Medicaid and Medicare were a down payment to get to universal coverage, and that by covering the most vulnerable, the seniors that we just heard about from Bethany, but also low-income women and children, pregnant women and children, were really the bulk of the enrollees when the program first began. That then we could then take on the easier task of figuring out how to ensure the rest of the population. Clearly, 55 years later, we're still working on closing that gap, but that was the intention behind the beginning of these two public programs for health. Notably, the final state to adopt Medicaid was Arizona in 1982. So it wasn't flipping a switch. Again, the federal government put forth a program, and then the states decided when to avail themselves of these federal resources. Unlike Medicare, Medicaid is a shared financing model. So there are state tax revenues that pay for the Medicaid program and federal dollars that pay for the Medicaid program. It's an entitlement program, which means it is designed to expand when the need goes up and to contract when the need goes down. And so the federal dollars come in the form of a federal matching rate or the FMAP. So each state gets a different amount of federal dollars based on their population, what their numbers look like, what the age of the population looks like, what the provider market looks like, the cost of doing business. But in general, the range that states are getting is between 50 and kind of 75, 80% under the Medicaid program. The Affordable Care Act in 2010, which obviously left a big swath of the population both not really able to afford buying into commercial insurance and not having a low enough income to really qualify for Medicaid. In 2010, under the passage of the Affordable Care Act, there was a requirement for states to all move up to 133% of the federal poverty level as a base. Prior to that, there were all sorts of, different eligibility levels. With federal state financing comes federal state guidelines. There were always a federal floor, but a lot of opportunity for states to develop their own policies, their own eligibility groups, their own benefit categories. The ACA really standardized a lot of that and defined what an essential benefits package looked like, laid that out for Medicaid, and required them by saying, if you participate in the Medicaid program, you need to cover adults up to 133% of the federal poverty level. As we know, 2 years later in NFIB versus Sebelius, the Supreme Court said, not so quickly, you have to make that voluntary, otherwise it looks like you're forcing states to take an action that we're not comfortable with. And so as of 2012, that became a voluntary choice for states. Today, all but 13 states have taken advantage of that opportunity under the Affordable Care Act. We've at the Commonwealth Fund have studied the impacts of what this has been ever since it was enacted, and I'll talk a little bit about that. But I think one thing to mention is that compared to Medicare, when you look across the benefit package, Medicaid is widely viewed as a pretty comprehensive benefit package. Behavioral health, mental health, in all states, it's the largest behavioral health provider and payer. Mental health, we have really compelling data for the flexibility of Medicaid and its ability to respond to public health emergencies such as the opioid crisis, and Medicaid's ability to pivot really quickly and respond in that situation, Katrina, and we're seeing it right now. We can talk a little bit more about how Medicaid has really pivoted to respond to the COVID situation. So as I mentioned, all but 13 states have taken up that offer that was put forth in the Affordable Care Act to expand to 133% of the federal poverty level. With that expansion came 100% of federal funding, so an enhanced match, which was an incentive for states to step forward. Next week, there's another state that is not able to approve Medicaid expansion through either their legislative or executive branch path, and Missouri is going to the ballot box, much like Oklahoma did a couple weeks ago. Oklahoma was successful and passed a constitutional amendment to expand Medicaid coverage in the state of Oklahoma. They also have a waiver pending, so guaranteeing some litigation coming through there. But just as a note that there are several ways states still have to take either legislative action or sign executive orders to make this happen. So as of right now, 13 states yet to have expanded. At the Commonwealth Fund, we do a lot of research. One of our questions is, how can we ensure states can learn from each other? How can the federal government learn from the experiences that we see in the states? And one of the questions that we knew was going to be valid and that we were hearing from states was, is Medicaid going to be a budget buster if we expand? And are we going to have this woodwork effect if we do expand our Medicaid program? And just in closing, that's not in fact what we've seen. We've seen that not only have states not busted their budgets, they've actually seen savings in other areas of their state budget, savings in the corrections area, savings in behavioral health and mental health, because of the services they're able to provide under Medicaid at the enhanced federal matching rate. So hopefully, I know we're out of time, hopefully in the discussion we can talk about the role that Medicaid's been playing in addressing inequities in the healthcare system, and especially during the time of COVID.
Thank you so much, Rachel, and thank you to all of you. We did not set you guys a very easy task. We said basically, give everyone a fantastic primer on how your program started, the context it came about in, the generational impacts, what it solved, and what the challenges are, and do it in like 5 to 6 minutes. So just wanted to start out by thanking you all. I had a question I was going to ask you, but in listening to these presentations, I actually have a different question I want to ask you. So sorry, I'm going to put you all a little bit on the spot, despite having just told you I'd put you on the spot differently about half an hour ago. One of the issues that came across as I was listening to both of our wonderful interns earlier, and then in particular, something Michele said triggered this. One of the factors in these programs is their complexity. How easy it is to access the benefits. In some cases, how you apply for those benefits, which is much different and much more true for some programs than others. And Michele in particular suggested that with respect to UI, that has a generational impact on how accessible those benefits are. I think we all are familiar with the idea of federal bureaucracy, rules, regulations, and navigating processes. And I'm just wondering if each of you could speak very briefly, and some of this will be speculation and some of this will just be things you know, about how navigating the process affects access and what your thoughts are on how that might have a generational impact, just knowing that younger workers are less savvy, have less familiarity, have fewer tools, and may just be less familiar with what's available to them. I'll start with any of you.
I'm happy to start. One of the, because Medicaid was the most recent kind of expansion that we really had to encourage people to sign up for, I think they took a very intergenerational approach. They had a no wrong door policy, that if you showed up at the emergency room, you would also qualify and get enrolled. They had folks working at the schools, and really started with, if you get the kids covered, then it's easier to kind of get the families and the parents involved as well. Just by the nature of the program, Medicaid's covering over half of all births in the United States and a vast majority of the long-term care needs. So talk about intergenerational. It's at the beginning and the end of life. Medicaid's picking up the bulk of the tab. So I think that's exactly right, making sure that we're streamlining those processes, making sure that there is no wrong door when possible, and help people really understand which program they're eligible for, because a lot of times, especially in the health space, whether it's private market coverage, Medicaid coverage, it's just really confusing. And so being able to wrap around and have that be really clear for beneficiaries is important.
Thanks.
So Elaine,
Yes.
This is Steve. I'd like to just be a little bit contrarian here on the idea of the younger generations being more challenged at Social Security. As I know you know that there's been a big push for a long time now about moving everything more online, including have people applying for their benefits online, obviously more efficient and easier. And my general experience is that the younger people are much more savvy with online than the older generations are. So I think this is really, it's the wave of the future. It's where we think we'll be going. That's going to be much more efficient. There's My SSA, and SSA has lots of web pages up and people can just tap into that. So I think people who are at all computer savvy, which most people are, especially people who are covered by Social Security, there should be pretty ready access. And I think the other thing too that is important here is that Social Security has been around so long, it's so well known. Who doesn't have a parent and or a grandparent that is getting Social Security? So people tend to have some familiarity with it. So, and it's almost as like a constant of nature at this point. Everybody is going to eventually get either a survivor, retirement, or disability benefit. So people are pretty familiar with it. So I think Social Security is in a very favorable position in terms of people knowing about it, knowing where to go, and knowing how to get the benefits. Not quite so true as some of the other benefits that you're talking about today.
I think that's true. Jay, Michele, either of you have some thoughts on that, about how that might be different?
Well, I think, if you look at unemployment insurance, it's odd because as it's moving, as application processes are moving more online, younger people are less and less likely to apply. And I think that that's a lot of it is a factor of how these online systems actually work. They are very archaic looking and seeming. I made a joke the other day that sometimes when I'm scrolling through these online applications, I expect one of the screens to inform me that I have died of dysentery, which is a joke, Generation X joke, I guess. But so. I really think that some of this too, the intergenerational problem is some of these programs are really hard to access if people have disabilities, if they have limited English proficiency, or if they're mobile. If they're trying to access via mobile, they're a little bit easier to navigate on a laptop. And so I think some of that has to do with like just the online, connectedness and application. But I really think that there are all these other hangups in the system that flag people, that keep people out, that are likely. I mean, just looking at the recipiency and age, it is odd to me that younger workers are less likely to apply for, but it's a habit too. Unemployment insurance benefits used to be easier to get and used to be more sufficient, and so people of an older generation recall that and are accustomed to applying for and receiving decent benefits.
Michele, you just said something that I think is so important, and that I know, unfortunately, we have a very short time to talk, and we're going to transition to our next panel, which is going to be amazing, and which will, I think, pick up this conversation perfectly in terms of where we have gaps and cracks that are showing and growing. And one of them is exactly that, and I think it's true. I'm going to just speak for Jay here. We're definitely seeing increasing challenges to getting benefits in many cases, and great disparity across states, as he said, in workers' comp. And one of the factors, I think, is exactly that, is that workers today are not nearly as confident that those benefits are accessible and available than maybe their parents or grandparents were, which may make them more skeptical. And as we think about younger generations' attitude towards social insurance generally, whether it's Social Security, which, as Steve said, might be much more accessible to the UI or workers' comp, which have much more complex systems to try to navigate. To what degree does skepticism about the availability of those benefits and about the desire of the system to work with people who need them play a role in the degree to which people access them? So I want to just really quickly do a speed round to push us toward the next panel, and that is just ask each of you to tell us in 10-15 seconds to pick if you see a place where the kind of risks that might be protected by social insurance are unprotected, or as we talk about with respect to health insurance, underprotected. What would be a top priority that you would love to see this panel be talking about?
I can go ahead and start. For, like I've mentioned, is long-term services and supports. That's not a benefit that is covered under Medicare. And obviously seniors and people with disabilities are more likely to be needing those services. And that's usually covered now through a combination of some private insurance for long-term care, but most of that's covered through the Medicaid program, which requires a lot of people, especially middle-income people, to spend down their assets and incomes in order to qualify for long-term services and supports coverage. So that's something I hope is tackled a bit in the next panel.
Seriously, none of my other panelists can think of an unprotected or underprotected risk?
Well, Elaine, I was going to just actually, Bethany took the words right out of my mouth, because long-term care insurance, it's kind of, the classic thing is what people have to spend down and then they go on to Medicaid. There are better ways, and obviously private long-term care insurance has not filled the bill. That does seem to be the biggest gap.
Thanks. Jay, you had
Yeah, sorry, I was trying to talk, and I think I was muted on my phone. For workers' comp, it has to be the growing number of gig workers and contract workers. Obviously, everyone knows Uber, Lyft, they were in the news for a workers' comp in California, going to court. But there's just a growing number of just even smaller organizations and new tech agencies that employ sort of this idea of a contract worker. You work your extra hours or you work your second job, who are under great risks and are not covered by workers' comp. So that's definitely something that needs to be addressed, and in what manner it's to be seen. But yeah, that's definitely the biggest challenge.
Thanks, Jay.
For unemployment insurance, I would say that we just need a better, more automatic system. I mean, this week, the $600 benefit has turned off, and it's now a political football. And we're going to see this with duration at the end of the year. I think, setting up a system that's more automatic and that kicks on and off more automatically in response to economic conditions is really necessary.
Thanks, Michele. Rachel, should we give you the last word here?
I have so many risks that I'm worried about in the Medicaid program. I'll give you one very egregious example. Maternal mortality has been very high profile in the news. States basically have the ability to decide how long Medicaid coverage for pregnant women extends once they've had the baby, and it ranges everything from 60 days postpartum up to 12 months. We know that by extending Medicaid coverage and making that across the board, putting that requirement in place for 12 months would address the time period where 95% of the maternal mortality and morbidities happen. And that just seems like a no-brainer. The women are being treated in hospitals and the babies are too. We're paying for them anyway. So even if we're just motivated by dollars and not lives, that's a place that I would look very, very closely.
All right, well, that is an excellent way to cap this off, pointing out that we could actually save dollars and lives at the same time. And they not only don't have to be mutually exclusive, they could complement each other. So speaking of complement, I want to give a big thank you to our panel, and a big thank you going forward to Kathleen and the next panel. Thank you all.